Hello, hello. Welcome. We are so excited to join you for your conference.
Hi, Alice.
So loans, lines of credit, and factoring. Oh my. So we've been talking to Andrew, and he told us that he's really the Wizard of Oz behind all this. So we thought a really interesting play to talk to all of the breweries and business owners out there about financing would be this reference to the Wizard of Oz. And so we are going to guide you, Derek and I, today through different financing options that are more traditional and maybe some ones that you haven't even actually heard about. So before we get into that, we've been poking around your Facebook community, and we're really excited to meet all of you. And I'm really excited to introduce you all to Derek Watson, who is a CFO and capital markets advisor who has so much experience in risk, lending, and all that. So Derek, just tell us a little bit about yourself, and don't forget to tell us about your favorite beer.
Okay, favorite beer is one called Belhaven Best. It's from where I grew up in Scotland. Whenever I go back there now, I live in the US these days. I make a beeline for a Belhaven Best. I just kind of really like it. It's kind of sweet and malty, and one of my favorites. About me, I'm a finance guy for 20 odd years, as it says here. These days, I provide fractional CFO support for small businesses to help them figure out their finances from the strategic angle, right? Do they have the data that they need to make the big decisions for their business? I don't have any brewing clients, but I like brewing company products, so happy to be here.
And didn't you start brewing at back in
Oh, yeah,
Scotland? Is that I remember?
that was a fun fact that I was going to do. Yeah, before it was cool. 25 years ago in school, me and my friends tried our hand at home brewing, and the beer was disgusting. We stupidly brought some into school with us and got into trouble for that. So, it was a long time ago. Kind of sorry, but not sorry for getting into trouble at school.
Well, that's why we have the pros doing that as part of this association. So, my name is Alice. Derek and I are both CPAs, and we are really, really interested in sharing how you can think about financing and cash flow management for your business. We actually work with one of the other partners at Craft Beer Pro Brew, and so because we offer so much guidance towards these companies in this topic, we thought it'd be really interesting to talk to the brewery owners about that. So let's just get started and talk about something that might seem obvious, but hey, cash is king, right? Who doesn't want more cash in the bank? But when we think about things that are going on in the environment right now, I mean, inflation, rising interest rates, regional bank declines, things that have just been going on in the past few years. Cash is really, really important for all business owners. And like I said, this might seem obvious, but even when they did this study last quarter, Deloitte, they found that executives across North America have pinpointed cash flow as their number one priority. So let's dive a little bit into this, Derek, and talk about what this means for breweries in general. Why is this such an important topic right now?
It's frankly it's always been important, but it's super critical right now because of all the rising costs and the shrinking margins that small businesses are dealing with. We know margins are not always high in brewing either. Um, we've heard about inflation, supply chain issues, increased interest rates, etc. We're not going to go into all that in today, but this is like the context for really what's driving shrinking margins. And in this climate, like your room for error has gone down, and it's basically riskier than ever to be running a small business these days. So getting a handle on your cash flow and your risks is super critical.
That makes so much sense. And here's the thing, when most people and businesses think about cash flow, they think, okay, I just need cash in the bank. I just need cash in the bank. But is that actually true, Derek? How should these breweries be thinking about cash flow management?
Yeah, I like to think about this in terms of three pillars really, right? Do you have the right financing strategy? What loan products are you using? How are you? What are the resources you're using to invest in your business? Do you have the right risk management processes? Right, business is full of risk on who you work with, who you sell to, who you hire, a bunch of things. And do you have the right people and tools in place to be making the right decisions for your business? So it's kind of a combination of all three. It's not just the bank balance. It's kind of how you're set up.
That makes sense. And so there's a lot of different financing options out there. And some folks might be familiar with them. And we're going to provide a really high level overview. We're not going to double click into too much detail because it might be overwhelming. But let's just talk through some of the more popular options. So, Derek, let's just start with credit card. Walk us through some of the pros and cons of that.
Yeah, credit cards. So a lot of, especially very small businesses, they start here, right? It's it's convenient. You get points and cash back and air miles and things like that. It helps you build your credit profile, and there's embedded fraud protection in there as well, from the credit card companies, which is helpful. So quite convenient. But if you flick to the next slide on the cons, obviously the credit limits that you get quickly become insufficient for beyond just getting started. And if you don't keep up with your payments, they're actually a really expensive form of credit. The APRs can be very high, and they rack up. So use with caution. It's convenient, but don't rely on it once you start hitting the bigger numbers.
So it doesn't make sense for a business or brewery to use the credit card, for instance, on a large capital purchase, it sounds like.
No, you should. Yeah, it's convenient for like your incremental, so consumable purchases, the small dollar, high frequency stuff. But for bigger pieces of, more expensive items, equipment, etc., no, it's an option, but it's probably not the best.
Okay. Makes sense. So an option for the larger purchases is probably something like a traditional bank loan, or even to get more specific, an SBA loan specifically. So why would a brewery look at taking out a loan?
Yeah, classic term loan products from a bank or backed up by the SBA. Yeah, a lot cheaper than a credit card, even with the increase in rates recently, still relatively much cheaper than relying on credit card financing. Build your credit. You can get a larger amount that makes more sense, especially for your capital purchases or your CapEx expenses.
Got it. Well, I mean, this sounds like a really good option. What are some of the cons that people don't realize when they're taking out a traditional loan?
Yeah, or maybe some people have realized, a lot of paperwork. You have to jump through a whole bunch of hoops. Kind of a little bit hard to get if if you're not quite the credit profile that they're looking for. You have to put up a personal guarantee. Some of the credit cards require that as well on the business side. But you may be putting up your personal assets, your house, in order to get this loan. And in some cases as well, there's kind of limited uses. They might allow you to spend it on certain types of things and not others. So it puts a little bit of constraint about what you can use the funds for.
Got it. Okay. So it might not be the best option, although it is typically a more popular option for businesses. Now, what about a line of credit? What would make a business owner choose a line of credit over one of these loans?
Lines of credit are good in the sense that you're not paying for money that you're not necessarily using, right? Like you've got access to the borrowing when you need it. You might have to pay some small arrangement fees, etc. But if you're not using it, you're not paying the interest, whereas a term loan, you're paying the interest whether you've spent that money or not. So from that perspective, it can be a bit more cost effective. It also provides flexibility, right? As it's there when you need to use it. You can kind of dip in and dip out of it as needed.
Well, it sounds like we should all have lines of credit. I mean, are there any downsides to using that?
Yeah, the main one is I would say they're like a fair weather friend, right? Like it's kind of there when you don't really need it, and then when you do need it, it's not there for you, right? Like they can quickly pull back their commitment on the line of credit, and then when you find yourself in a jam, you need that access to those funds. Suddenly, it's actually not available. So it does create this false sense of security in some ways. It's like with many lending products, the people that need it most actually can't get access to it when they need it. And having it available does potentially create a risk of like overspending and overutilization of it. Term loan, when you have to go through all this paperwork and provide a business plan, etc. There's some controls, with a line of credit, it can just be tempting to dip into that and lose some kind of diligence.
Right. So it may not even be always available, to your point, which is why somebody might look at another form of financing.
Yeah, sure.
Okay. And what about leasing? Because we know that breweries will also look at leasing as an option when they're looking at purchasing like larger types of capital purchases.
Yeah, there's a couple of different types of leasing to think about: operating leases and finance leases. We don't need to go super detailed into that. The main concept is that it lowers your upfront costs, when you're purchasing equipment, and it lets you smooth out your cash flows, right? You're paying a lower monthly amount over time rather than a lump sum upfront. So
Okay.
that can be convenient.
Well, it sounds very convenient because it's almost like renting, right? You don't actually have to pay for everything up front. Are there
Right.
any downsides?
Right. Yeah. So over time, actually, you may end up just like renting a house. You may end up paying way more than you would have if you had purchased. Right. Like if you add up those monthly payments over 3 or 5 years, they can be quite significantly more than if you were able to purchase that asset up front. They can be there can be use restrictions. You don't in some cases you don't actually own it. You're operating lease, borrowing it from someone. So if you wanted to make any modifications or or things like that, then there might be restrictions on your use of it. And because you don't own it, you can't use it as collateral for further borrowing, for example.
Got it. Okay. Thanks, Derek. And as you mentioned before, having the right people in place to also advise you on your journey of figuring out the right type of financing is important. So for any business, the right type of financing for you is going to depend on your situation. So if you have a mentor or coach or peer group, or better yet, a financial advisor, they can help you walk through the specifics of what will work for you. Is that right?
That's right. I mean, there's lots of options. It's what is the right option for you is, sometimes just, you need a bit of help figuring that out.
Right. Okay. So now let's talk about something a bit more interesting. There are also non-traditional forms of financing that businesses don't necessarily know about. And some of these actually play into that risk factor that you had mentioned before as well. So let's go over some of them. And some of you might have heard of these and some of you might have not. So invoice factoring is a very popular option. Talk us through that, Derek.
Yeah. So, it's been around for a long time. It's still what would be considered an alternative lending method. But invoice factoring is a product that allows you to turn your receivables. So where a customer, owes you money to pay for their purchase, you can actually turn that into upfront cash. Typically, it's available quite quickly, which can get you out of a jam if you're in that position of needing the money from your sales to cover your expenses.
Okay. Well, I mean, this sounds like a good option. So if I have an invoice and I don't want to wait to get paid, I can just go to an invoice factoring company. Sounds a bit too easy. There's got to be some downsides, right?
Yeah. So with invoice factors, they are actually quite expensive. They'll take quite a hefty cut of the funds that they'll advance to you, and eventually get paid. And that's because of the risk profile of the types of businesses that typically use factors. If you think about it, that business is in a position where it's not able to pay its bills without resorting to a factoring service. So that business is risky, and therefore, from a factor's perspective, they're going to want to get compensated for that risk, and therefore the product is actually expensive. Reputationally as well, it's also not a good look, right? Because what will happen is they're inserting themselves in between you and your buyer. The factor will front you some cash, and then the buyer will be required to pay them. So it's inconvenient, not a great customer experience for your buyer, but also, like I say, not a great look for you, because it kind of indicates to your buyer that maybe you've got some financial problems, and that makes them wonder about working with you and the stability of supply and things like that, right? Reputational issues. Eligibility, not everything is eligible for factoring. What they like the most is, small business or large business selling to a large business. So they're confident in that
Okay.
large business's ability to pay for that invoice. Um, but what they don't really like is the sort of small to small, because it's not really worth their while, economically to get involved in the small transactions with counterparties that, they're not able to properly credit assess, for example. Um, so available, but not in all circumstances.
Mm.
And then the recourse part is, yeah, if your customer doesn't pay, you'll be required to pay the factor back what they fronted to you. Not, the non-recourse is available as well, but the typical factoring arrangement is what's known as recourse.
Got it. Okay. So invoice factoring, while in theory sounds like it's a good tool, if you have some invoices that you need some cash on, it might not even be available to you and you might have to pay back. So maybe
Um,
not the best option for small businesses.
yeah.
What about trade credit insurance, also known as accounts receivables insurance?
Okay, so this is something a little bit different, whereby you can pay insurance to basically guarantee, let's say guarantee up to 90% of the receivables that you've got from your customers. So if your customer doesn't pay or ends up for whatever reason paying really late, you can actually submit a claim to your insurance company and get that money, guaranteed on day 30 or day 60 or whatever the terms of the insurance contract are. So like anything, you pay a premium. The insurance company's taking the risk, and they'll pay out if that risk materializes. It's kind of a way to sell, to feel confident about selling on credit and not having to worry about whether you're going to get paid or not. Right, and with this type of product, you'll get paid eventually, rather than risking not getting paid at all.
Okay. And insurance, I mean, when we talk about risk management, insurance is something that all businesses should consider. So, I mean, this seems like a safe option, but walk us through the cons.
Oh, well, the cons are that they typically have like minimum volume requirements. So it could be, $2 million or $5 million of accounts receivables, which it would make it worth the while of the insurance company giving you access to their product. So not a lot of small businesses meet that threshold. Also, being insurance companies, they are very bureaucratic and have old school processes. It's like that the SBA loan we mentioned earlier on, a lot of paperwork and a lot of diligence being done. It's just slow. And then there's also the limited coverage element. Like not everything will qualify for insurance. A bit like those factoring companies, they'll approve coverage for large businesses that they're confident in, and they won't necessarily approve it for smaller businesses that they don't know. So exactly where you've got the most risk concerns is where they won't provide you with the coverage. So it's a bit like this fair weather friend, with the line of credit as well.
Okay, understood. Talk about this new type of technology that we're seeing in the fintech space, where people can actually get advance payment on their invoices.
Right. So there's a bunch of new companies out there, fintech startups, which are basically giving you access to a lot of the pros that we were just talking about, while not having to deal with many of the cons that we were just talking about. So basically, innovative ways to help small businesses take control of their cash. They do this by embedding themselves into your business processes. For example, you would use them to do your, any risk assessment that you're doing over your buyers, or you would use them to collect on your invoices and process your payments. And if they're plugged in to your business processes from that position, you get access to their software and their people to help you out. From that position, they can give you a cash advance on your receivables with, at no risk to you, right? So it's a lot of the positive things from the factoring, from the line of credit, from the insurance, but without all the hassles. The trade-off is that you have to sort of embed them into your business processes, but you get a lot of value from that as well. So think of it as sort of a bundle between a bundle of like software and financial services that lets you optimize your processes and get access to the cash flows that you need, in an environment like this.
Okay. And then what about the non-recourse part of this? Because you'd mentioned this when we talked about factoring.
The non-recourse part of this is, so basically because they're embedded into your tools and processes, they'll have the visibility and confidence to make decisions that they'll stand behind, right? It's like, we know that you've been working with this business for a while. We can see in your data that they pay on time. We're confident in giving you, 90% of the value of this invoice up front. And, that's at our risk, at the vendor's risk. So it's about, I guess, being so close to you and being such a embedded business partner that will actually stand behind their decisions and give you the money at no recourse.
Oh, wow. That's putting a lot of confidence into their processes. And you talked about invoice factoring and how it could potentially create that reputational damage. If your buyers learn that you're using a factoring company, it might signal to you that, oh, you might not be doing so well. But in this case, it sounds like these types of companies actually partner with you and don't create that reputational damage. Instead, it might even enhance the way that your buyers view you and experience you.
Right. So typically it's a white label experience. So from your buyer's perspective, they from what they see, they're just buying from you. This is all kind of like powered behind the scenes. So they might not even notice that there's a third party involved. And the like you were getting at there, the part of the benefit of that is, the reputational stuff goes away, but also because you're partnering with a third party that specializes in this, you're actually able to provide your customers with a better payment experience. A nice portal and all these tools and reconciliation tools, etc., that you wouldn't be able to provide on your own. And that, you can eventually kind of flip that into a sales driver, right? Where, you're getting a reputation as providing an excellent, payment experience for your buyers, and you're providing credit, seamlessly, etc. That can be a real engine for growth if used correctly.
Okay. It almost seems too good to be true. And you mentioned some of this already, for instance, having to really work with this company because they're embedded into your services. Are there any other cons that breweries should know about?
Right. Yeah. So you do have to, embed a business partner, which requires, effort and commitment. But then the other angle to this is it's not really something that you can kind of dip into or out of, right? For those one-off invoices, like a factor, for example, you could use them for one particular account that you might have concerns about, or or you just need to use it this month. It's not really like that. It's much more of a embedded process. So that comes with trade-offs on just the effort to integrate them into your business processes.
Okay. Well, thanks for walking us through these non-traditional forms of financing. And actually, this touches upon a really important point, because people might be wondering, well, why would you need to factor your invoices? Why do you need to purchase insurance on your invoices? And it's because of this concept that not a lot of people talk about, but you and I certainly have. It's that breweries and businesses are acting like a bank without even realizing it. So walk us through what this means.
Right. So that's basically where you're squeezed in the middle, right? So you're being required to pay your suppliers upfront or on short payment terms on the one hand, and then on the other hand, your customers are requesting and asking, and you're kind of commercially, kind of forced to give them extended payment terms, which are maybe longer than what you're getting from your suppliers, and you end up squeezed in the middle, right? You have to pay your suppliers before your buyers are paying you. And that's just a classic, working capital crunch that, in essence, means like you're acting as a bank to both your suppliers and your customers.
And that can be really challenging because, businesses have to run the business. So to then also act like a bank can just add on additional time and costs and efforts. And that's why these alternative forms of financing exist, right, to help businesses and breweries manage their cash better. And in fact, there was this interesting stat, I believe this was from a QuickBooks survey, that businesses are spending approximately 14 hours a week on things related to collecting payments. So to your point, not only are they acting like a bank, but it's really taking valuable time out of their day to collect on payments. So Derek, do you have any tips for businesses on how they can speed up the collections?
Yeah, the trick to collections is, sort of early and often. You start it with, even before an invoice is due, you could send out a reminder that says, hey, we got, you got this invoice, got this payment due in a few days, just letting you know. And then as soon as it's past due, following up with regular, messages, emails, calls, and just getting on the phone, saying the right thing to the right person at the right time can unlock some of these things. But again, that's work, right? So doing as much as possible in an automated fashion, tee up automated emails that would go out, pulling in the statement and the invoice information and getting that to the right contact person, right? The accounts payable department or whoever it may be. And then, following up with a person at the right time, not straight away, but, give it a week or two and then start getting a human involved. These are things that you can do to stay on top of it, or to not let all these slow pay and no pay issues develop.
Right. Yeah. And so this is part of having the right tools and people in place as a part of your cash management strategy. And here's the thing. I mean, for those of you who are already offering terms, you understand what that is. And if you're not offering terms, we bet you're being asked for terms, because more than 50% of businesses are asked for extended terms. But the question is, how much credit should you actually give them? And so now we roll into more of the risk question. So Derek, can you teach us all how to run a credit check like a pro? What do these businesses need to know?
Okay, yeah, credit checking your business buyers. The status quo, I would say, is a lot of people just go by their instincts, right? Their gut feel. I like the person. They seem like a good guy.
Right.
I'm sure he'll pay. But that's not a great way of doing it. I mean, you might be right some of the time, but the times that you're not can end up being quite expensive. So I would definitely think about taking a more a nuanced but still formulaic approach to what you're trying to achieve.
Okay.
Right. So there's objective data that's out there and available. You can look at a business's credit score. You can look at their payment histories with you. You can look at subjective information like their website, their customer reviews. Does it all kind of stack up and look good and look legitimate? And then I think a key thing, which is often overlooked, is the intent part, right? Like, why are they asking for terms? On the positive side of the spectrum, it's because they're a decent sized buyer and they've got, accounting and control procedures and accounts payable processes, and it's a perfectly legit ask for them, all the way through to the negative side of the spectrum where you have people that literally have no intention of paying. They're just looking for free stuff, right, to basically defraud you. And that the context in which a person is asking is important, right? Like, is it normal? Is it expected? Is it industry standard? Just trying to put things into context, whether the request for terms is kind of reasonable or not.
Yeah, this all makes sense. I mean, when you, as the expert, explains this, like, okay, yes, reviewing all these things. And I guess just going back to the fact on collections, I mean, if businesses are already spending 14 hours a week on payments, they're going to have to spend even more time considering things like this, right?
That's right. Well, it's a bit like, preparation is half the battle. If you're making better credit decisions, you won't have as much collections to do, right?
That's true.
So kind of invest up here to save time later. But point taken. Like, you can't expect business managers and brewery owners to be doing everything, right? So that's where some of the partners, like the fintech companies that we were talking about earlier on, can can fit in. They've got software that does this. They've got people on hand to help you out, and you get that confidence that decisions are being made well in the context of your business. You're getting the money up front. You're giving your buyers a better payment experience. There's a lot of positives.
Yeah. Okay. So these are good things for everyone to know. And, if it gets to that point where it no longer becomes scalable to you and you're spending all those extended hours, it's good to know that there are things like automated tools and outsourced services that businesses and brewery owners can use to help them with all these things. So this actually leads to the question, wow, there's some issues when it comes to offering payment terms, right? People don't pay right away. You need to spend time following up. You need to do all these credit checks. Why even bother offering payment terms, Derek?
Well, sometimes it's table stakes. If you want to be in that line of business and you want to sell to those types of customers, you're going to have to kind of meet the payment preferences of your buyers. There's a bunch of management theory literature around the power of the buyer versus the power of the supplier, and in many cases, if the buyer has more power than the supplier, who's hungrier for that deal, who has options to go somewhere else, then they're going to try and get as favorable payment terms as possible from you, and you're going to have to kind of find what you can do to somehow meet in the middle. If you want that business. So unfortunately, not everyone not all of your buyers want to prepay. On their side of the fence, their perspective will be, well, why should I prepay? Why should I pay up front for something before I've even received it, before I've checked the quality, before I can verify that you've sent me what I ordered, right? So there's who's got the bigger need, the risk need, right? I want to make sure you're selling me what I'm paying for, and then on the other side, it's like I want to make sure I'm getting paid for what I'm shipping, right? You got to meet in the middle somewhere, and payment terms helps with that.
And like you said, it in the industry usually is table stakes, and whether you're offering net 15, usually net 30 is standard, but we've seen businesses even go up to net 60 and net 90.
Yeah.
Right? Depending on your space.
Well, in this environment, all the CFOs and accountants and big people like that, they're advising their clients to get ask for as long as payment terms that are as long as possible, right? Just to because if you've got a better interest rate in the bank, you can park the money in an interest account, get a few dollars interest, and then pay your invoice in 90 days, right? Like it actually starts, these kind of things come into play, which we haven't had for a long time when we've had really low interest rates. But traditionally, before really low interest rates, that's what people used to do.
Yeah. And like we mentioned, that stat we have, 52% of businesses are asking for terms. And so for everyone here, I mean, if you're not being asked for terms now, it is something to consider, because your buyers might start to ask for the reasons that Derek mentioned. And Derek, you and I have talked about this too. It's to actually reframe payment terms as not as, oh, this is just something I need to offer, but to rethink it as actually a sales strategy. So when we think about typical sales and marketing strategies, I mean, there was Julie's great session yesterday on sales pipeline, but you can actually use your payment terms to grow your revenue and expand your customer base. So when you think of it as that, as a strategic driver of the business, it actually makes more sense for business and brewery owners, right?
That's right. Like there's you can play not to lose, right? Like, oh, I don't want to make sales and not get paid, or I'm worried about this, that, and the next thing. Or you could use net terms to play to win, right? It's like, how can I actually drive more sales if I'm fully confident in my ability to make good risk decisions, to get invoices paid up front, to have people, a team that's got my back on collections and payments. You can actually flip it to a sales driver rather than something to be approached with, caution or even extreme caution.
Right. And so these are some of the companies that actively use payment terms to drive growth. So Pro Brew, as we mentioned, another partner of craft beer, is on this, and a few other companies. And not to get too detailed, because we want to keep this high level, because this can be a lot of information to take in. But we just want to thank you all for joining us today. If there's any questions, please enter them into the comments now. And just to wrap up, Derek has gone over a really high-level overview of some of the traditional forms of financing you might be familiar with, and some of the more alternative and newer options of financing. We've talked through some of the tools and processes you can put in place for better cash flow management, and also how to better risk manage. You have some tips now, and if it's not actually an option for you because you're busy running the business, don't worry. My company Resolve is actually really excited to offer all of the members of Craft Beer this very special offer. Get some time back. Let the pros run your credit checks. So if you're interested in this, we are offering 10 free credit checks on approved buyers, and also extended buyer credit lines for them as well. So if you are interested, just scan this QR code and feel free to email either myself or Derek if you have any questions about any of the financing options that we covered today. So Derek, did I miss anything? Is there anything else to share with this group?
No, I think you covered it, Alice. Thanks a lot.
Okay. Well, thanks everyone. We hope you enjoy the rest of the day. I'm definitely going to tune in to watch Carrie's session. That's always a fan favorite, I know. And until then, have a great day.
Bye.
Bye.